For the first 3 months of the year, the first quarter until end of March, markets were down more than 7%. We've recovered some of that. But market volatility is not the investor's biggest enemy.
You're right, Theo. Market volatility is unsettling, but certainly for a long-term investor, it's by far they're not their biggest threat to their capital. In fact, it's going to be something which you don't read about in newspaper headlines. It's actually going to be inflation. And that's the silent killer to wealth over a long period of time. People will try and buy certainty with their money, especially if they're going into retirement. So they'll look for things that are extremely low risk, that can give them a predictable growth rate on their money. And for most investors, that's going to be cash. And especially in conditions like we're seeing now, where, as you say, the market's down for the first few months of the year, and even over 3 or 4 years, they haven't really been rewarded for investing in shares. What investors would be doing now is saying, okay, let's just put my money in cash and make sure that I can get some kind of a growth rate on my cash, which is all good and well, except the problem is it doesn't really grow your money against inflation, and that's going to be the issue here. Is inflation is the silent killer to wealth.
Warren, just to put inflation into perspective, I had a look at 30 years ago, the exact tables from Stats SA in terms of purchase power. And if you go 30 years ago, $100 30 years ago, 1988, you need 800 Rand, just more than 800 Rand today to buy the same parcel of goods that cost you 100 Rand 30 years ago. Now that's where inflation comes in. So if your $100 30 years ago had grown at a level less than inflation, the purchase power today would not be available to you. And that factor of 8 over a 30-year period, there's no reason why that should not continue. And that means you have to make sure that your purchase power of your income stays intact. Now, from an investor point of view, how do you get that right?
So I think the answer to investors who are looking to beat inflation is going to be unfortunate if they don't like the volatility of stock markets, because you have to take an approach where you get growth assets in your portfolio. In other words, you're going to need to buy things like shares, and you're going to need to buy things like listed property. You don't need to become a share expert yourself. You can do it via a unit trust or an index, but you are going to need to understand that that's what you have to do. And just to give you an idea, I mean, if you put your money 50-50, half of it into shares, half of it into the bond market, which is very typical for what a balanced portfolio would look like over a long period of time, and you leave that, and you draw an income from that over your lifetime, that kind of a portfolio should last a heck of a long time, about 35 years. So that means the purchasing power of your money, which is what you've been talking about, would continue to keep pace with inflation, and you'd have a good quality of life for 35 years, which is for most of us going to be as long as we would be retired. Now compare that to cash, for example. If you put the same money into cash and you say, right, I'm going to spend the same amount as the other person and let that escalate with inflation over my lifetime, you're going to run out of money by the age of 22. And for most people, that will actually, sorry, not the age of 22 years. For most people, that will be before they actually run out of life. In other words, they're going to run out of money. And that's the problem. So we've been talking about volatility, we've been talking about inflation, and I think the trick here is don't worry too much about volatility. Don't worry too much about your money not necessarily growing at a fast rate, because that's what stock markets and bond markets do. They don't just give you this nice predictable growth like cash. What they do is they give it to you in lump sums, and they take it away sometimes. But if you're patient and you have a long-term focus, what happens is your capital does grow. The income that you can draw from your capital grows, and it grows faster than inflation. And that's really the thing that you want to accomplish. Don't worry about getting certainty of cash, because all that you're doing is buying certainty that your money won't keep pace with inflation. And that's a disaster for all retirees.